Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is Vessi Kapoulian. And Vessi is the founder of Dream, Believe, Achieve Capital Group. I love that name. A real estate investment company based in Los Angeles, California. Vessi started her real estate journey in 2017. Today, Vessi controls a portfolio of investor real estate properties in Florida, Tennessee, and Georgia, 319 doors, 36 million in assets under management. Vessi's professional background includes 15 years of commercial lending and 4 years of business management experience. Her commercial lending experience has served her well in developing a conservative, analytical approach to assessing risk and investing prudently in real estate in order to maximize returns. Her business experience has helped develop a solution-oriented, execution-focused approach, which has served her well in asset managing her real estate portfolio. So Vessi, welcome to the show.
Thank you so much for having me as a guest, Keith. I look forward to our discussion and adding value to the audience.
Absolutely. And I think you'll be able to do quite a bit of that. I can't wait to dive into some of the commercial lending stuff with you. But I always start with really where you grew up. And in reading your bio, it sounds like there's a very interesting story there in itself. We could probably do a podcast about, but we'll kind of just get a little bit of background on it. But yeah, tell us a little bit about where you grew up and what eventually led you to real estate.
Absolutely. So I actually grew up in Bulgaria, so on the other side of the pond, during very interesting times. The time Bulgaria used to be a communist country, so grew up behind the Iron Curtain, where access to additional information was very limited. And so as a little kid, I decided, my parents told me that if I ever learn English, they'll send me abroad. And that was like something impossible to even think of at the time. So I got to work, studied English, and they actually kept their promise and sent me to the UK as part of a school program. And along the way, as I started studying English, I also learned about the US, the UK, just different countries outside Bulgaria. And that really inspired the dream to be able to come and study to the US one day. By virtue of studying English and really leaning on academics, because that was really the only way I could make that dream happen, since I didn't really come from a family of big means. I was ultimately awarded scholarships, and that's how I was able to cross the pond, came here, and this is home now. Since I came, I kind of followed the traditional path of going to school, getting good grades, joining a firm, climbing a corporate ladder. And along the way, after a few years and getting a few lessons, the light bulb went on. that I was perhaps climbing the wrong ladder, or at least the wrong ladder for me. Because as I looked up, I saw a lot of my colleagues, managers, senior executives, the higher they went up the ladder or the chain, the more they traded time for money. And then along the way, there were different events that happened, such as the global financial crisis of 08, 09, that unfortunately left a lot of people either with decimated retirement plans or without a job or both. My own employer went through a couple of restructures, and especially with the last one, I had to say goodbye to dear colleagues who were very smart, bright, capable, hardworking, but that had nothing to do with the decision. I suppose they were let go, and that's when I thought, well, what if that happens to me? I don't control the global markets. I don't control corporate restructure. So what could I control to effectively impact my own destiny and not be in that position down the road? And I think in those moments of crisis, you fall back to your habits. So when I was growing up in Bulgaria behind the Iron Curtain, there wasn't really a stock market or a developed stock market. So when people talked about investments, they talked about real estate, not necessarily cash flowing properties, but perhaps being able to buy their own home, perhaps second family home, and just lean in on the equity build up over time. So the concept of investing in hard assets was buried, I could say, deep down there. And that seed finally germinated after those few events happened in my life. And in that moment of crisis, when I was asking myself the question, what do I do to control my own destiny? Real estate emerged as the natural answer. Initially, my journey started with investing in a single family home, and that was going to be my small little retirement nest egg and a way to diversify from the volatility of the stock market. But that investment worked out really well, which then gave me the courage to make another and eventually expand into the multifamily space. And now I'm on a mission to help other busy professionals create that optionality in their lives and personal freedom.
Yeah, that's great. And this is definitely the audience for that. A lot of our audience are W-2 professionals, and they've invested in the stock market. They're familiar with the company 401k, and many of them know about real estate, of course. But a lot of folks surprisingly don't know that there's this avenue to be able to invest in hard assets like real estate, like multifamily. So
yes,
that's great.
There isn't a lot of information out there, and I think the beauty of real estate is that people can get engaged in multiple ways. They can do it actively, like I chose to do, but they can also do it passively, and that's the beauty of it, having different options.
Yeah, for sure. And so when you started with the single family, where you bought them and then put long-term tenant in there, or what did your single family kind of portfolio look like before you made the shift to multifamily?
That's a great question. Personally, for me, I was looking for a long-term buy and hold cash flowing property. Living in California, financially, that was very difficult to do, not only because properties are a lot more expensive here, but also in order to achieve decent cash flow, one needs to put a pretty substantial down payment. And that wasn't an option for me at the time, which is what caused me to look out of state. So all of my investments to this date are actually out of state. And I started with long-term buy and hold, single family / duplexes, basically residential properties before transitioning to the multifamily space.
Okay. And what states did you start out in?
I started in Tennessee.
Okay. Yeah, no, that's great. And that even is kind of interesting in the sense that a lot of people, and you did it kind of as a necessity. It wasn't, something you could do, invest in your own backyard. Right. So you went somewhere else. But that alone is a big leap for a lot of folks to take, just to invest in something halfway across the country. Did you use, I assume, property management that handled the rent collection and, helped with the maintenance and that kind of thing?
Absolutely. So the way I sourced the investment, again, curiosity was driving me at the time, as well as a very deep burning why, due to some of the events that I shared. And again, I didn't want to look back years down the road, or God forbid, if I was let go when I'm 60 years old and think, well, I should have started 20 years earlier. So the fear of regret was definitely driving that. And when I couldn't figure out a way doing that in my backyard, I naturally looked out of state. So I started joining different local meetups. Some were in person, some virtual. And at one of these meetups, I met an investor who consistently talked about investing out of state. And one day I picked up the phone and called him and just asked the simple question, do you know someone who sells properties out of state? And sure enough, he did. So he already had the network set up, connected me with a property manager. And eventually I selected a home that I wanted to purchase. We found a tenant. So it took a little bit of legwork to get it up and running. But once I made that first investment, build a relationship with a local real estate agent, local property manager, that really helped scale my portfolio from there, because I already had that team set up that I could lean on to help manage the day-to-day out of state.
Yeah, for sure. And so with the single family, how many did you end up buying before making a shift to multifamily? And I guess part of the same question here would be, during all this time, you mentioned kind of climbing the corporate ladder, and you did commercial lending. Is that what you were doing at that time, is in the commercial lending space?
Yes, that's correct.
Okay. So you're doing these things in addition to that, which is cool.
Absolutely. I was building that business in parallel for a number of years before I transitioned to it full time. But yes, to answer your earlier question, once I got to property number 4, that's when the light bulb went on, and I asked myself, well, this is not just a small retirement nest egg. This can be actually something bigger. How do I scale that? And as I started doing the math, it became apparent very quickly that if I want to achieve a certain income level, I'll have to buy hundreds of single family homes and manage that. So in my desire to scale and really simplify the process, that's when I decided to transition to multifamily. On the one hand, I could leverage my asset management experience, especially out of state. And then on the other hand, I could leverage my professional experience as a lender in assessing properties.
Yeah, for sure. And so with the first, tell me, I guess, a little bit about the first multifamily. Where was it, and how many units, and what helped you make that leap?
Yes, that's a great question. When I decided to make the transition to multifamily, I invested very heavily in education, because even though I had the lender background, I didn't necessarily have the background on the operator side of the equation. So looking at the downside versus the upside and modeling out projections. So invested heavily in education, including joining a mastermind specifically focused on multifamily. And joining that mastermind really helped accelerate my journey, not only from a content and educational aspect, but also networking aspect. And that's where I met a lot of my partners. So when I joined the program, I decided to focus on 2 things. One, lean in on my strengths and skill set, which was underwriting. So naturally, that led me to start in the acquisition space or sourcing deals. And secondly, focus on one market. I already had some presence in Florida, specifically Central Florida, through my managing my single family portfolio. So focused on a market, focused on a skill set, and got to work. Underwrote hundreds of deals, almost 200 to be precise. And while I was doing that, I was also building the infrastructure, connecting with lenders, insurance brokers, talking to other investors with the goal of eventually finding my partners. So by the time I got a deal, I wanted to have everything set up and ready to take down the deal. And that's exactly what happened. Eventually, I was able to build broker relationships, and eventually through one of these relationships, I got the first deal. Having looked at 200 deals, the minute I saw it, I knew this is the one. It became very apparent. And at that point of time, reached out to fellow investors from that program who I knew would be interested in the Florida market, joint venture opportunities. And we ultimately were able to successfully close on that first deal. And shortly after, the second one followed, which is, I guess some people call it the law of the first deal. But that was kind of the journey of the very first one.
Yeah, for sure. Yeah, it's funny how that happens, how it takes a little longer to get that first one, but then all of a sudden it starts kind of going from there. You mentioned being part of a mastermind, and I'm a big proponent of masterminds myself. I've seen what they've done for me. A lot of folks may even hear that and say, well, what the heck is a mastermind? When I first heard it, I was like, what is this, like the guy that wants to take over the world? Like it just it sounds like this evil group of people that want to take over the world. Mastermind. Yeah. But it truly is, an opportunity to exchange ideas with people who are already doing it at a higher level, that can support you. Some of them have already gone through what you're about to go through, and so can kind of give that helping hand. But what mastermind was it, or what program did you get into from the multifamily? If you mind sharing which course or which group it was.
Yeah, not at all. And when I was looking for various options, there weren't too many available. I think now there's even wider, bigger menu of options out there. But I ultimately settled at the time based on what was available with the Warrior program, which is the Ratcliffe is the leader of that, and the Lifetime Cash Flow, I think is how it's known. For a number of reasons, of course, multifamily, but the whole aspect of mindset, personal development, personal growth, that also resonated with me. And that's how I made that decision.
Yeah. And on your commercial lending that you were doing, what aspect of the commercial lending were you doing? What did you specialize in with that?
Great question. So I started in the international space, banking middle market, multinational companies. Then the opportunity came to get promoted, which is when I transitioned to the domestic division. And at that point of time, a pretty substantial part of our portfolio was real estate. And that's where I got my first exposure to commercial real estate underwriting, specifically multifamily properties, commercial retail. I had some hotels, industrial, and some other special purpose properties. So that really opened my eyes on how to evaluate those from a lender perspective. And really, again, that seed started slowly germinating when I saw a lot of my clients effectively being able to make this a full-time occupation and not just a side investment.
Yeah, that's super inspiring. And it's a great perspective to have, to be in that ahead of that. You're having to see what are the lenders looking at. And I think maybe you could probably speak to this as far as one of the things I think, especially passive investors, they don't necessarily always recognize that, you're going through, of course, the sponsors underwriting that they're doing on the property, but then there's the lender that goes and dives into the numbers as well. And so it's really, there's several steps there to help assure that it truly is a good deal, that it's going to, service, you're going to be able to service the debt on it. But can you maybe talk a little bit about, with your experience, kind of what lenders are looking for and how that maybe does help to assure that it's a decent transaction?
Absolutely. And before we even get to the transaction, I would say from a lender's perspective, but even for me today as a capital partner looking to collaborate with different operators, it really starts with the people. Who are they? What is their reputation? What is their track record, experience? That's where it usually starts in building that relationship. Because as lenders like to say, it's people pay back loans, eventually properties. I guess if you have to get to that point, but it really comes down to people and character first. And then it's the property and the underlying collateral, ability for that property to cash flow. But all of that is ultimately predicated on the operator's ability to either turn it around and get it stabilized and then run it at an optimal level on a day-to-day basis. So it starts with the people, and then as to the property, of course, the market, submarket, the condition of the property, all of these are factors that are being taken into consideration. And last but not least, of course, the cash flow aspect of it.
Yeah, for sure. Okay. And so what are some of the biggest, like the top 2 or 3 things that you were able to pull from your W-2 and from the work that you were doing there to really be able to apply to, being a general partner on a multifamily deal?
Great question. So of course, I would say one aspect is the underwriting piece of it. But really looking at it from a lender's angle, right? As an operator, we're often looking at what is the opportunity, what is the upside, how can I maximize this asset? And these are all very important items to consider as you're evaluating an investment. The lender would look at it from a risk management perspective. What is the downside? How do I get paid back if everything goes wrong? What is the absolute downside? What is the baseline? So there was definitely a learning curve for me as well as I was making that transition from the lender angle to the operator and being able to balance both sides of the equation. So knowing how the lenders would evaluate a potential opportunity, knowing that whatever version I presented will probably be cut back and modeled down versus up, helps. And not only that, but also when looking through deals and the term sheets and what you are able to negotiate, what you're able to ask for, and what are the deal breakers, the items that are just set in stone. And last but not least, reading and understanding the credit agreement. It's been surprising to me that not many people dive into that. And that's so incredibly important to know upfront, because that's the roadmap. That's the contract between you and the lender over the duration of the loan or the whole period of the deal. And so knowing the rules of the road and being able to either negotiate certain items upfront, or the do's and the don'ts has been helpful to have that perspective as I approach loans as an operator.
And maybe what are some of the ones that people don't necessarily realize? Number one, that they're negotiable. Certain things are negotiable. Which ones to ask for, or maybe surprises that you've seen that just people weren't aware of, but this was tied into the rules of the loan and between you and the lender.
Yeah, these are great questions. And a lot of it also depends on what type of lender as well, right? The agencies maybe won't be as flexible, but if you're working with a local or regional bank, for example, which is the world where I came from, there may be more flexibility there. That can pertain to certain buckets or carve-outs, specifically as to capital expenditures or maybe intercompany loans. I see, especially today, a lot of people talking about, especially for deals that are in distress, about bringing in other partners or perhaps making a shareholder loan to the entity. And unless that is carved out up front or permitted up front, if people do that, that's basically a violation of the credit agreement and can and will result in default. So understanding some of these negative covenant buckets and what's permissible there and what not. Reporting requirements is another one that people are sometimes surprised about. Not only your annual operating statements and rent rolls, but certain insurance reporting requirements that you may have to deliver on an annual basis, or even the type of insurance you're required to have. So it may seem like there are little nuances like that, but it also really sets the stage and the relationship you build with the lender. Lenders don't necessarily like to be surprised. So if you are running into a situation, it's always best to have that conversation, at least from my experience. Again, I can't speak for every single lender out there, but it's best to have that conversation up front so you can proactively come to a resolution versus surprising the lender and then asking for permission. That's not always the best case scenario, especially if you keep doing it on a consistent basis.
Yeah, for sure. And so like on this first one, you said it was down in Florida. What from there, Vessi, what did you do? And I guess a follow up to that would just be with the folks that you met through your mastermind. Are you still working and partnering with them, or has that changed? And is it more deal specific?
Excellent question. So, I still am not with all of them because the deals vary by location and market, but some of the partners from my Florida deals are partners in my next deal, which happened to be in Georgia. And the third deal I did is with the same partners from the first Georgia deal. So definitely there's been a carryover from one deal to the next. We've had on all my deals, I would say I've been very fortunate so far to be working with great people, great operators. So we've done more than one transaction together.
Okay. And what areas what does your portfolio look like from a geographic standpoint? Obviously, the first one being the Florida, but what are some of the other areas?
Yeah, so the Florida deal was the very first one. So I started small with 11 units and eventually expanded into syndications. The syndicated deals are both in Georgia. One is in Augusta and the second one is in Savannah, Georgia. I've liked the Florida market a lot, but over the last 18 months, it's been very challenging to get the numbers to make sense there for a number of reasons. And we can talk about some of that, but that led me to pivot and transition to other geographical locations.
Yeah. And I guess I'm assuming you're referring to the insurance rates and stuff that have gone up considerably in Florida, but there may be some other things. Is that really what you're seeing there? Is just, it seems like it's astronomical.
The exorbitant increases in rates, as well as the lack of predictability or lack of certainty. It's not uncommon for insurance to either drop coverage. I guess from my perspective, seems kind of on a random basis, or even force you as an operator to replace, for example, roofs that may be only a couple years old. Which you may or may not have factored into your business plan. So I guess it's a combination not only of the increased premium basis, but also the lack of predictability that's causing, at least for me, it's causing some concerns.
Yeah, makes sense. How have you liked the Georgia market so far?
So far, it's both properties are performing well, and they're what I would categorize as secondary markets with diverse employment base, solid median household income, and both were stable value add properties, so not very heavy capex or repositioning requirements. But there has been an upside in rents where the legacy owner hadn't necessarily maximized that opportunity. So, so far from expense wise, rent wise, top line wise, local regulation wise, there haven't been much surprises. I would say this year we have seen maybe a little bit of a slowdown with processing on some of the eviction requirements, but not as bad as some other markets like I know Atlanta, Houston are experiencing some administrative delays over there. But at least in those secondary markets, it hasn't been as bad.
Okay. So I want to talk maybe a little bit about your journey as a W-2 employee, and then kind of building this empire on the side that you've got. And then at what point, what were maybe some of the goals that you had? Was it, once I get X amount in income, then I'll be able to dedicate full time to this, or what were some of the thoughts, and maybe just kind of take us through your journey there.
Absolutely, yes. So for many years, I was building that on the side, and what that meant is I had to be extremely well organized. Thankfully, this is one of my strengths, but it meant a couple of things. One, being able to draw the line that look, I will be in the office from 8 to 5 or 8 to 6, and that's when I'll be fully dedicated right to my employer. But the hours before, the hours after, and my lunch break it's my time. And those were really the hours when I started reading, educating, eventually connecting with investors, doing the work, underwriting those properties. So being able to be disciplined about the time, especially time blocking, was something that was extremely helpful. And as far as the timeline, I definitely had some income goals in mind in terms of, here's the bare minimum I have to head to at least cover my bills, a basic bill, basic living expenses. Then here's the number 2 goal, and here's my ideal number. And that's kind of how I set the timeline. And every year I would make goals, reinvest all my bonus and any extra savings, invest all of that into real estate, as well as invest passively, because I'm also a passive investor. And the residential space and multifamily in particular is what I focus on the active side, but I also invest passively as a way to diversify my own commercial portfolio. So it was really the combination of those active and passive investments that over time added up and eventually got me to my freedom number, so to speak. But it's not something that happened overnight. Real estate does take time, does take patience. And I would say I wasn't growing very aggressively. I was doing more of the slow and steady approach, but that's what worked for me based on my schedule. And that's how I got to that point where I was effectively able to make the transition.
That's great. That's great. And I guess one of the things too, we're obviously going through some interesting times right now with the interest rates and with lending in general, and with some of the defaults that are coming, down currently, and there'll be plenty more this year that we'll see. What are some of the maybe changes that you've made when you're underwriting a deal, but also maybe anything that you've seen different that lenders are requesting?
Absolutely. So definitely the one thing I like about underwriting, that it's not a static process. It's constantly evolving, not only with the property and the market and submarket, but also with the macroeconomic and other market conditions. Historically, I've always, and at least for my portfolio, all of my properties have been done with fixed rate debt. But it's something that I'm even more cognizant of nowadays, and making sure that option is on the table as I'm evaluating various loan opportunities. And of course, depending on the whole period, usually fixed rate debt comes with prepayment penalties, making sure that's also factored into my returns or potential returns. Definitely being more cognizant of the underlying assumptions when it comes to rent growth, adjusting the expenses, especially insurance, taxes, labor, and then the entry and exit cap rates. If you had asked me a year ago, I probably would have told you I've definitely expanded my reversion rate from the I think most people traditionally do 10 basis points a year to maybe 20 basis points a year. Now cap rates have somewhat, not fully, but somewhat caught up to the rise of interest rates. So now I'm moderating that reversion rate a little bit with the thought of, at least in my humble view, that we're probably at the peak of the interest rate escalations. Maybe there is one more. We'll see, depending on what the economic data and I guess the lagging indicators that the Fed is typically looking at suggest. But I tend to believe we're at the top of at the hikes at this point. So that's naturally leading into more moderate cap rate reversion in my modeling as I evaluate those underlying opportunities. And as far as lenders, they're definitely their underwriting principles haven't changed, right? They're continuing to underwrite based on cash flow. But because cash flow has been constrained due to rents moderating, expenses increasing, debt service due to higher rates also increasing, naturally that's leading to cash flow compression. So how they're controlling that part of the equation and meeting those minimum debt service requirement is naturally by reducing the debt proceeds, which is why you're seeing the 50-60% LTVs in the marketplace versus the historical 70-75, even 80% loan to value ratios. Especially with some of the events that took place earlier this year as well with Silicon Valley Bank. To me, that was almost like a deja vu of the 08-09 crisis. A lot of regulation came into place for the top tier banks. I think that will now trickle down to the mid-tier level, which naturally will lead to higher compliance requirements for some of these lenders. That will lead into reevaluation of their internal caps in terms of how much they will lend per segment, whether that's real estate, industrial services, and so forth. And even within real estate, they may calibrate their internal concentration caps on how much they want to lend. So down the road, that will lead to, in my view, a couple of things. One, more limited availability of capital with some of those lenders, but also enhanced or increased merger and acquisition activity. Not sure if that will hit the bottom tier banks or the smallest of the smallest. I think they will probably maintain a lot of flexibility until maybe the next crisis or the next market event. But certainly for the mid-tier, I see some more restrictions and, again, higher cost of capital, which will naturally translate into either more limited lending and or higher rates for those lenders.
With rates themselves, you mentioned kind of being at the top. And I think I know neither one of us have a crystal ball, but being in the industry as long as you have and going through 08, you have some perspective on this. So what are you anticipating over the course of the next, 1 year, 3 year, 5 year time frame when it comes to commercial lending rates?
Yes. So again, not a crystal ball, I guess, based on what we know today. I think a lot of if you were to ask me based on a lot of the leading versus lagging economic indicators, I think we're already in a recession, but that will probably come to play in the numbers sometime next year. And naturally, once we get into economic slowdown, the Fed tends to lower rates. I think we also have the wild factor of elections next year, and that may also come into play in terms of decision making. How far will the Fed drop rates next year? I don't think it will be too far unless we get into a very, very deep recession. So when I mention expected rate drops next year, if the Fed funds is around 5.50 today, maybe they drop it to 5, no more than that next year, and probably keep it there for longer until they have a really good grasp that they fully reined in inflation and got them back to a more stable point. Are we ever going to go back, I guess, in the next 5 years to those 3% rates? I don't know. It's very hard for me to see that today, but I will also say it was very hard for me years ago to see that we're going to go to effectively zero rates and negative real rates. So I guess from the perspective of today, I think settling down at that 5 to 6% is where I see things. And that's how I'm underwriting my deals as well. So assuming those would be the rate I'd expect certain spread, if you will, between what I think the rate would be and the cap rate at which I project to sell. So I'm baking that into my exit assumptions. But again, that's with the expectations that rates will stay in that 5 to 6% level for an extended period of time.
What about maybe shifting gears just a little bit? Tell me a little. I mean, obviously, a big piece of what we do is educating, potential investors. Can you maybe talk about some of the advantages of investing passively? And you're doing both, so you're actively doing the multifamily. You've got some passive investments as well. Can you kind of share what some of the advantages of, I guess, each are?
Absolutely. So, in terms of the active side, it's really, doing the work, doing all the heavy lifting. I enjoy the process. I love doing that, doing the deep diligence on the markets, the operators, underwriting the deal, looking at the sensitivity analysis. And then after closing, it's seeing that investment through its life cycle and the intended hold period, and making sure we're making the appropriate strategic decisions, right, to execute on the business plan. But not everyone wants to be engaged in that capacity. Either people have no desire to do that, or they don't have the time. There are a lot of people who love what they do and are not necessarily looking to change jobs or careers. And that's where passive investing really comes into play, which allows busy professionals to take advantage of the benefits that investing in real estate offers, such as diversification, tax efficiencies, building additional income stream, without having to do that heavy lifting and being involved in the day-to-day operations. I just want to say it's not completely passive, because as a passive investor, you still have fiduciary responsibility towards yourself, right? To do the diligence on the sponsor, the at least high level view on the market, and being able to understand the underlying investment and what you're putting your hard-earned money towards. So it's not completely passive, given some of that upfront diligence and then monitoring your investments over time. But it's certainly a lot less involved from a time perspective versus doing it actively.
Yeah, for sure. What are some of maybe the things that you like to see on the passive side from a communication standpoint with a group that you've invested with? How frequently, and what are some of the things that you like to personally see with that investment as they send you the reports?
That's an excellent question. I like to receive monthly communications, even when things are going great. I feel like it's always easier to scan that email quickly and delete versus sit there and wait for a message or the communication to come through. So the more frequent, the better. And then in terms of information, at least having a brief synopsis of, hey, here is what happened over the past month. Here are the key drivers. Here's the set of financials, balance sheet, income statement, statement of cash flows. At least have that information. If I, as an investor, have more questions or desire more information or want to peel the onion further, if you will, then I have the ability to reach out to the sponsor. So them being responsive over email is definitely a bonus. Being transparent, being accessible. These are some of the things that I look at, and not being afraid to deliver bad news or maybe not so great news, because I would rather know upfront if or when things are happening versus being surprised.
For sure. Yeah, no, I totally agree. Okay, well, I guess maybe if we could find out how folks can find out more about you, if they'd like to get on your mailing list or find out about any potential. Are you raising for anything at the moment? Or?
Not currently. But I'm constantly looking at new opportunities and building strategic relationships with operators.
For sure. So how can people find out more about you? I think the two of us met on LinkedIn. And so that was good. But how can folks learn more about you, about your company?
Absolutely. The easiest way to connect with me is LinkedIn is one, but through my site, dbacapitalgroup.com. D is in dream, B is in believe, A is in achieve. My contact information is there, a direct link to my calendar, a ton of complementary educational resources, specifically designed for passive investors, including a copy of my complimentary digital book, The Busy Professional's Quick Guide to Investing in Multifamily, which is designed to educate and empower investors.
Awesome. Well, there we go, audience. That alone is going to be worth the trip to the website. So, how about, I got two more questions for you. I've enjoyed our time together, Vessi, and I've really enjoyed hearing about your story and, some of the commercial lending side of things as well. Just think you bring a lot to the table there. Very knowledgeable. What if you had some advice that you could give someone who's maybe just starting out in their investment journey? What would that be?
I would say the first step would be define your goals. What are you looking to accomplish? Then get educated. That's very important because you're making pretty big decisions when it comes from a dollar perspective. And then take action. The first deal is usually, the first investment is usually the scariest. But as I look back, the only regret I have is not starting sooner. So even if it's a small step, whether that's buying a single family home or starting with that very first passive investment opportunity, get educated and take action. And you'll look back one day with no regret that you created that additional income stream and wealth building tool.
Absolutely. No, that's great advice. How about one more thing? How about a book recommendation, something you've read recently? It doesn't necessarily have to be real estate related, just something impactful that you've read recently.
Absolutely. From a mindset perspective, I recently read 10X is Easier Than 2X by Dan Sullivan. So that book quite resonated with me and really shifting your thought of linear versus exponential growth. And on the more practical side, I enjoy reading textbooks. So Tom Wheelwright's Wealth Ability book, I'm blanking on the title, I apologize, is one that I particularly enjoyed reading. It really simplifies the concepts from a tax and accounting perspective. And I always like to refresh myself on that topic as well.
Absolutely. I know which one you're talking about, and I would jump in if I knew the title, but we'll put it in the show notes. How about that?
Wealth. I think it's tax-free wealth. Now it's starting to come back to me, but yes. Yeah.
Okay. All right. Well, when you're not investing in real estate, what do you like to do out there in California?
I like to run. I used to run marathons, half marathons. Now I just jog without having that pressure to compete for time, but I really enjoy running.
Yeah. Okay. So cool. Me too. I'm training for a marathon as we speak.
That's
so
amazing.
Yeah, it'll be a fun trail run. So. All right. Well, Vessi, I have enjoyed having you on the Wealth Flow. You brought a ton of value to our listeners, and thank you so much for joining us here today.
Thank you so much, Keith. I really enjoyed our conversation.
I did too.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.